Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. As a long-term investor, there's nothing better than buying a stock and just being able to forget about it for the next 10 or 20 years. So I wanted to put together a list of a few stocks, and to do that, I asked Lou Whiteman to come on and help me. Lou, how are you doing today?
I'm good, Travis. Good to see you.
Before we get too far, I do want to remind you to subscribe here to Riiv Investing. We'll be covering a lot of great investments on this channel. The first pick that you had, Lou, was a stock that I'm not familiar with. So why don't you go through who TransDigm is and what it is that they do?
Yeah, TransDigm Group, TGG is the ticker. So, Travis, when I think about this, I love stocks, but I also love not worrying about stocks. I like doing other things. So, when I was thinking about this, I was trying to find businesses. These are businesses in my own portfolio that have been through, and the two I picked, it's the same shock, but kind of the worst case scenario has played out, and we got to see how they reacted to it. And that's why I really like these stocks as far as set it, forget it, just don't worry about it. TransDigm, think of TransDigm as a private equity firm, but that trades on public markets. It was put together about 20 years ago by some very, very smart people who know the aerospace sector. And what they do, they are basically just the holding company of a group that buys small companies, doesn't really integrate them, integrates them to some extent, where they can take advantage and just let the business work. TransDigm targets basically airplane parts. Commercial aerospace parts is one of their biggest units. Conventional wisdom is that's not a great business. That's a middleman business. You're squeezed by your things on one side and the manufacturers, the Boeings of the world on the other side. But TransDigm has made kind of niche for themselves with specialized parts that are necessary. Most of these parts are either under patent or they aren't in demand enough that you could set up a second facility and just run it 24/7. But if you're Delta Airlines and you need to get a plane off, this is a part that you need. So you will pay through the nose for this one part when you need it. And that's sort of what has set TransDigm apart. For as long as I've owned the stocks, Travis, it has been generating 45% plus EBITDA margins. 45% plus for
which is phenomenal in the manufacturing business.
Company. Yeah. And for as long as I've owned it, I have been told that is not sustainable. And yet here we are a decade later. Prior to the pandemic, this stock posted a 2,500% return thanks to that. Since the pandemic, it is up 81% from its low. This is a company that went through the ultimate shock because airplanes stopped flying. And you don't need spare parts when airplanes start flying. And when I think set and forget it, this is, if you want to talk about the worst case scenario for a business, how about a global pandemic where every airline basically ceases operating? Turns out TransDigm, about 80% of their costs are variable. Yes, they do debt, but they do pretty conservative debt. Right now, I'm looking at a debt picture. Most of the major maturities aren't until 2024. And with what interest rates have done, it's actually an advantage to have all this debt at this low rates, arguably. This is a business that went through the ultimate shock, came through with flying colors. I see nothing on the radar that makes me worry that they, in time, maybe one day we won't have these 45% margins. They have a ways to go until they don't. They continue to generate cash. They put that cash to work buying companies. They don't pay a dividend, but every now and then when they have excess cash, they just write a $40 per share check. Trading any times 2023 EBITDA on an enterprise basis, enterprise because of the debt. This is just one that I want to hold forever because I know their track record. I've seen them through the worst possible moment, and it just keeps on chugging.
It's always fascinating, these manufacturing companies that just find this profitable niche and they're just able to keep generating returns off of it year after year after year. And it's like I've been following a Heiko,
yes, similar company. Yes,
is another company, a very good operator, niche manufacturer, has a bunch of different businesses in their portfolio. And you kind of look at it and you go, gosh, this is really expensive. This isn't going to be sustainable, right? And then 10 years later, they're doing the exact same thing. They're just much, much bigger and much more profitable. So I like that concept. I feel like this is an underappreciated piece of the market.
I love that you mentioned Heiko, because Heiko is often compared because about half of their business is aerospace, and they go for kind of the similar playbook. I don't personally think they've done it as well, but that's a style choice. Heiko, though, does have they have healthcare. I mean, they did really well with some of their just components for healthcare during the pandemic. Yeah, there are businesses you have to find. You don't want to be too commoditized. because that is what has happened with manufacturers. But, in finding parts that are just very valuable to the end product, but aren't necessarily just ball bearings, where, someone could churn out 50 billion of them. That is TransDigm and Heiko are two great examples of companies that are they just know how to find these businesses. You are betting on the jockey. You are betting on their continued ability to find these if you want growth. But look, TransDigm has a 20-year record of doing this through now management successions too. I believe in these guys.
Yeah, I like that one. I'm going to go with a name that you may have heard of. That is Xcel Energy. Utility, nothing particularly exciting about being a utility in the U.S. Most of its business is regulated. But I want to give a few stats here. 22 price to earnings multiple. That's maybe relatively high for a utility. 2.9% dividend yield. But think about the markets that it serves. Most of its business is in the Midwest. I'm here in Minnesota, so they are my utility, and Colorado, where there's potentially disruption from things like people putting solar on their roofs is in particularly states like California and Arizona in the South. Solar is not particularly prevalent here in Minnesota or in Wisconsin next door or even in Colorado. So that's, I feel like, one of these threats that has been coming for utilities for the last decade that is probably going to be more regional in nature than we would like to think. That utilities have also found a way to make their own money off of some of these solar advancements and wind, things like that. Xcel Energy is a huge owner of wind. So if you are into renewable energy, this is actually one of the bigger renewable energy companies in the utility space. And so I think the underappreciated piece in utilities today is there's going to be a tailwind from electric vehicles. I don't know how big it's going to be, but if you look at electricity usage over the last 100 years, you could almost bet year after year it was going to grow 2%. Until about a decade ago, we kind of hit this plateau where people started using LED light bulbs instead of incandescent light bulbs, and refrigerators got more efficient, and everything it wasn't that we were doing less things, it's that we were more efficient with the electricity that we were using. So that was a pressure point for a lot of utilities. I think that's going to change over the next decade as more and more people have electric vehicles in their garages, as we have more commercial chargers, as people are doing more energy storage. Well, somebody's got to control that energy storage and give the signals. Guess what? Utilities are going to take a piece of that pie, even if the battery storage system is in your garage. So I think this is the kind of business where it may be a little bit lumpier than it was in the last 40 years, maybe 20 years from now. We're still going to have utilities. They're still going to be generating regulated returns. I just think this is a business we don't need to overthink. Just set it and forget it. Collect that dividend. It's a great business to be in.
Yeah, this is common throughout energy, and I think there are, I don't know how contrarian it is, but it creates opportunities where, yes, the future is going to be different, but it's going to take a really long time to get there, and it's not going to be the way we see it, and that creates opportunities. I mean, we saw with oil and gas, like with what everything that's happened in the last year, and I think it's, as you say, it's definitely true, especially with the geographic advantages for the company, disadvantages for some of the other things, that, yeah, we tend as investors to get caught up in the future and underappreciate how long it's going to take to get there and how little we could see clearly about the details of how we get there. And that, I think, does leave great companies with sustainable businesses for definitely within an investing timeline, kind of under the radar or unappreciated, where they are just great. Just have it, stick to it. And as you say, don't worry about it. Don't stress about it.
Yeah, and I think there's a lot of disruption coming to the energy space, but one area that I just don't see being disrupted is electricity. If you're a fan of ChargePoint or Blink Charging or Rivian or Tesla, guess what? All of those companies need to have electricity going to their chargers or their vehicles. Where does that electricity come from? It's not magical. It comes from a utility. I just don't see that business model going anywhere because it's so big and so ingrained in what we do every day. It's an infrastructure piece that we're going to build on top of. Yes, there's going to be changes, but these infrastructure companies, this is something I think we've learned over the last 20 years, is that for all the changes that are going on in the world, infrastructure is really important. And this is a great way to play that.
Very cool.
What's the third one you had for us, Lou?
Okay, so kind of cheating here because I said at the top that kind of what I thought about this, I wanted to think about businesses that have been stress test. And I'm using the same stressor for my other thing that I just use as TransDigm, but it's a very different business. I'm going with AerCap Holdings, AER. And what they do is the last 20 years or so, as the airlines have gotten more towards thinking about, wait, we're supposed to be profitable, is the airlines have tried to get more asset light, where they used to buy all their planes and bring all these assets on campus and on their balance sheet. Now there's a lot bigger leasing business. It's a great story, Travis. It goes back to the troubles in Ireland, where this industry came from, and all these companies, all these leases are still based in Dublin, but it's this little niche business of businesses that take on debt, buy aircraft, sign long-term leases with the airlines, and make money off of the basically of just outsourcing the balance sheet. It sounds scary, especially in a world where, say, a pandemic happens and airplanes stop flying. AerCap shares lost almost 90% of their value there, but the business just kept chugging along. And that really, as far as set and forget it. So let me tell you a bit the details of this company. AerCap in 2021 bought something called GCAS from General Electric for $30 billion. That was number one and number two in this industry. So you have created just a powerhouse. And I am not exaggerating when I say if you are Boeing, if you are Airbus, and you want to come up with a new plane design today, your first call is not to Southwest Airlines. It's not to any of it is to AerCap. It is, will you buy this plane? They are now the kingmakers in this industry. You're talking about a company with a portfolio, a fleet of 2,000 planes, 200 customers worldwide, a lot of different aircraft models. This is a young fleet. More than half are considered new tech. These airplanes that the airlines want because they burn less fuel. They have more of the comfort and amenities. There's still a lot of post-COVID fear here. Analysts are slowly coming back to this opportunity, but there was a real head for the exits. AerCap, Travis, beat earnings per share estimates by 46% in the last quarter. And a lot of that was just people still don't believe they got through this as well as they did. Turns out they had a lot of unencumbered assets. For all the debt that they take on, they run a good balance sheet. They own assets that people want. If they need to sell a plane, again, it's this young generation technology. Look, yeah, the stock got killed during COVID. Today, it's basically back to where it was, even though it's a much more larger, diverse company now. And wow, was it battle tested. I just think I used to love this company because I liked the opportunity. It has moved, thanks to the pandemic, to a set it and forget it because after seeing how they got through that, I'm not worried about the next business downturn where airlines see demand fall by 5% or something. It's just this has moved to set it and forget it as just a company that the model works and they know what they're doing.
Yeah, it's a little bit like buying a real estate asset and your fluctuations are in, well, what's your occupancy and what's your rate that you can charge, but you still have the asset. I like that one. And it's an interesting way to play the airline industry and the advances there. I think sometimes we forget about the fact that travel around the world is still increasing all the time and demand for new planes. I just saw a quote from AerCap CEO saying that there's going to be delays with some aircraft. So it seems like the airplanes that exist today are going to be in even higher demand. So I like that. I like that play in the airline space.
That was a great point you made because just, yeah, again, I'm bullish on travel. Global estimates 2 to 3% growth annually for the next 20 years. You have an emerging markets all over the world, like that's the second tier market coming online. I don't really want to buy any one airline. I think to take advantage of this huge opportunity. I think TransDigm and AerCap are ways to just play global demand for travel as the world gets richer, more developed, without having to figure out, okay, I like this one in the United States, and they take on all that single company risk. It's a great way to capitalize on a mega trend, both of these stocks, without actually having to pick winners and losers from that trend.
Yeah, I like that one. Another one to play on some of the mega trends is 3M. I worked at 3M 15 years ago for about 7 years. And what was interesting then was you could kind of see the slow deterioration of the business. There was a lot of new competitors coming from China and India, but this was still a premium company making premium products, having really good margins. It's just you didn't want to pay a really high price for a company like that because you could see the slow but steady deterioration over time, and they squeezed everything that they could out of the business. Today we're sitting in a very different situation. The stock's price to earnings multiple is 10.5. Dividend yield is 5%. and we're starting to move manufacturing back onshore. So I think the tailwinds are going to be behind a company like 3M, as not only the US wants to manufacture more things. 3M's sales is about 70% overseas, so it does have a huge business overseas. But from a technology standpoint, a lot of their best technology is still in the US, and then they export a lot of those products overseas. So you want to see incentives to make things here in the US. I think that's going to help the company not only from a cost standpoint and from a government incentive standpoint, but their customers too. If you are Apple and you're manufacturing a lot of your products in China, you're really worried about losing any piece of intellectual property that you can. I don't know what the number is today, but a decade ago, there was like 6 or 7 3M films in an iPhone. So this is a component supplier that makes a lot of stuff that you've never heard of and will never realize that you're actually using their products. But it's everywhere, and it's an integral piece of the industrial economy. Just to go through their business units: safety and industrial, transportation and electronics, healthcare, and then consumer is the stuff that you know, the Post-it notes, the Scotch tape, Scotch guards, stuff like that. But that's a relatively small piece of the business. Organic growth in all 4 segments, 1.7% to 3%. So we're not talking about a high growth company here, but you're getting it for 10 times earnings, a really solid dividend yield. I just think this is, again, a company that we can set it and forget it. There's going to be ebbs and flows of innovation. There's going to be ebbs and flows of margins as competitors come in and out of the market. But being an established manufacturer, like we have talked about with a few of these stocks, that does what they do really well, I think is going to be a really good, safe place to be for the next 10 or 20 years. And if you're getting in at a good price, which I think you are with 3M, I think that's a good spot to be.
You know, it's funny about this one, Travis. Like 5 years or so ago, I would have argued with you on this one. And I think I was wrong. And I think, in my defense, I think I'm just the conventional wisdom here. And I think what makes this interesting as a pick is that I think me and the rest of us with our conventional wisdom was wrong. 3M, the sexy story of just the accidentally inventing Post-it notes. I think as investors, we got too caught up on that. It's a great story. Just this idea that the Tinker Time, the idea that they were just constantly, this was a different kind of company, that it was an imagination company, and that's how they made their money. And is that fading? They're doing healthcare deals now and blah, blah, blah. It's the magic gone. And while that narrative actually, I think, has some truth to it, I think it missed the bigger point that you're talking about, that they are still a darn good manufacturer in a lot of areas with need. And I think for me, it was a case of missing the forest for the trees. And I think the market got caught up in that. And I actually really like this pick, but it was one that, again, I would have really argued with you just a few years ago, just on perception of the company.
Yeah, and I think that's part of my background. I started about the time Jim McNerney started. So McNerney came from GE, brought Six Sigma, which was really this focus on margins and listening to the customer and stuff like that. And so I know that was always the narrative, right? It was innovation, Innovation Boulevard at 3M. But the reality inside the building was it was a lot of incremental gains, not shooting for home runs. And so that's okay if everybody's expectations are the same, both from an employee standpoint and from an investor standpoint. And it seems like right now we're probably at the point where those incremental gains are what's priced into the stock. It's what employees, everybody expects. We're not expecting the next Post-it note because there hasn't been one for 25 years now. The brightness enhancements were kind of the last big one, and I think that was invented in the 90s. It's squeezing a little bit more margin. It's expanding, the number of tapes that you sell. It's just like little small stuff, and 3M has gotten really good at that over time. And it's all about price that you're paying for a lot of these kind of companies. And it's okay to just be a really good manufacturer and do the stuff that you do and not grow 30% a year. So that's kind of where we are with 3M. All right. Well, thank you for watching. I hope you have enjoyed these set it and forget it stocks. I think these are great stocks to own for the next 10, 20, 30 years. But leave your comments in the comment section below. I'd love to hear what you think about these. And if you'd like to hear more about companies like this, follow Riiv Investing here on YouTube. Thanks to Lou for joining me, and I'll see you here next time.
Cheers.